Hello everyone, welcome to our YouTube channel. And in this video, I will be talking about a very interesting strategy which you can apply in range-bound markets. Even though I have spoken about this before, I keep upgrading some of my videos so that you understand it better and how you can apply in the current market scenario. So before we begin today's educational session here, if you are a new subscriber and watching the videos for the first time, please do subscribe because we bring out videos every single day for educational purposes. And if you have any comments or feedback about our videos, please feel free to comment. We also have a Telegram channel which I personally manage, and where you will see stock market updates every single day. So let's begin today's session. So how to trade range bound markets? What is the safest way is a very big question. So the answer to this question is simply butterfly spreads. And as of date of making this video on 19th of January, as you would see that markets Nifty and Bank Nifty are stuck in a particular range. And the best strategy, the safest strategy, I would say, which you can apply in this kind of market is to apply a butterfly spread. Now, what is a butterfly spread? Why it is called butterfly? So, butterfly spread basically is a limited risk strategy, which is which is one of the strategies which is used frequently in a range bound market. So if markets are stuck in a particular range, you can apply this strategy. Now, the construction is very simple. Buy one in the money call and two at the money calls, and one out of the money call for protection. Now, this the construction itself can change. Now this in the money can be at the money also, and then two out of the money, and then far out of the money. So this can keep on changing. So butterfly spreads are created on, or if it is a long call butterfly, it is done on the call side, and you can also create on the put side. You can even create on both sides. That is can be called as a double butterfly spread. So with an example, I can show it to you. What you are doing is you are buying one call here, and then selling two calls somewhere here, and then buying a far out of the money a call for protection. That is for in case markets moves in a huge upside move, or if there is a huge upside move, then you can actually buy that for protection. This works pretty well in Bank Nifty. Nifty also it works very well, especially when it is range bound, like which is happening from the past few weeks. So call side, as you told, the construction can differ. Here in this example, it is in the money call, two at the money. You can so what you're doing is you are balancing the ratio itself. So one call here, you're buying one call here, you're selling two calls, and you're buying one. So you're buying two and selling two, but the ratio, since it is since you are selling two where the premiums are high, and this is completely for protection, in the out of the money call, what you're doing is if the markets are stuck in a range, time decay will be your best friend, and that's the reason these strategies are used, especially when there are a lot of time decays. So time decay is is an option buyer's worst enemy, where it keeps on decaying. So if you buy this call here, it keeps on decaying with time. So another 2-3 days or 1 week, if the markets are stuck in a range, the buy call which you have purchased will keep on reducing, and same happens with this also. So what will happen is this will be a best friend here. Now, one important thing which you have to keep it in mind is when you are selling, this can change too. So if you are buying one, it is not necessary that you have to sell two. You have to actually sell two or more. You can even sell six. All you have to do is you have to balance the buy option. So if you are selling here six, then you have to buy five 5 in the end for protection. So again, the same thing in put side. So in this example here, it's in this example here, this is the Nifty, and you can actually buy this, sell 2 here, this one, and then somewhere here you can actually buy one for protection. So that's a typical um, butterfly spread. This can change between in the money or so these shades here, just as to give you a glimpse, these shades here are in the money calls, and these shades here are out sorry, in the money puts. So in this example here, it is buy one in the money call, two at the money calls, and one OTM call. Now this can change to, you can buy this here to one at the money call, and then two out of the money calls, 2 or 3 or multiple, and then buy far out of the money for protection. This is also possible, and there is the butterfly strategies are so safe that you can actually um, construct it in the beginning of the month, preferably, but you can also do it in the later parts of the month, or the last 2 weeks of the month also, because this is completely low risk strategy. Especially when markets are stuck in a range, this would probably be one of the best strategies to construct. Now, when to avoid the strategy, I personally would say please avoid the strategy when there is a big event coming up, because when there is a big event coming up, there is a very good possibility that there will be big movements either side. Now there's also a possibility that in big events the markets might be stuck in a range. It's possible. The IVs will also be high, but I would suggest to avoid this strategy at that time. Or even if you want to construct, you probably can construct on out of the money, not in the money. So there's a way to construct it to be on the safer side. But during big events, it's advisable to avoid these strategies. Now, one important thing to keep it in mind is whenever you're selling options, you would have to have more margin than normal. When you're buying an option, all you need to have is the premium into the lot size. That's the margin you need. That means the full margin. When you're selling options, whether it is stock or index, you need to have almost futures margin. And recently, SEBI has increased the margin requirements. We are just hoping that that is temporary, but the margin requirements have increased. Probably for the next few months, or whether it will be permanent or not, it's a big question. But because of the volatility ahead due to elections and other events lined up for this year. So that's pretty much about butterfly spreads. This is the payoff diagram. As you told, this is exactly how it looks like a butterfly, and that's exactly how it is set up. So you can call it double butterfly spreads when you are creating on both sides. If it is on the call side, it's known as long call butterfly, and on the put side, it's known as long put butterfly. So that's pretty much about it. If you have any questions related to this particular strategy, when to apply it, and the break-evens and adjustments, please feel free to comment. However, there are a few adjustments which you can do, but if you are a long term, if you have 1 month's view, you can actually apply it very easily. So that's pretty much. Thank you, and I will see you again on my next video.